Here's something that might surprise you. In the 2023 to 2024 tax year alone, people in the UK put almost £69.5 billion into cash ISAs, but only £31 billion into stocks and shares ISAs. That's more than twice as much sitting in cash as being invested. Now, don't get me wrong, saving cash is important. But here's the thing, we're a nation of savers, not investors. And unlike countries like the US or Australia, where investing is just part of everyday conversation, most of us here in the UK have never been taught about investing or how it can help us build wealth for the long term. The government knows this is a problem. In fact, during the 2025 autumn budget, the Chancellor specifically talked about encouraging more people to start investing. So if you've been thinking about investing but don't know where to start, you're in the right place. Hello, I'm Gary and I'm here with Moneyfarm today to answer one simple question. What's the best way to start investing if you live in the UK? Let's dive in. First things first, let's start by debunking a myth that stops a lot of people before they even begin. You do not need to be wealthy to start investing. I know that might sound surprising, but it's true. That might have been the case back in the day when you had to hire a stockbroker to buy and sell investments for you, but those days are long gone. Today, thanks to technology and low-cost online platforms, investing is more accessible and affordable than it's ever been. And you can start with small amounts and still build a meaningful investment portfolio over time. So if you've been telling yourself, I don't have enough money to invest, it may be worth revisiting that assumption, because needing a large sum to get started simply isn't the barrier it once was. Now, while you don't need to be wealthy to invest, there are a couple of things you should have in place before you start putting money into the markets. Think of this as building a solid foundation for your house before you add the fancy rooms. First, your emergency fund. Before you start investing, it's a good idea to have an emergency fund in place. This is money you keep in an easy access savings account or cash ISA that you can get to quickly if life throws you a curveball, like your boiler breaking down, an unexpected car repair, or worst case, losing your job or having your income drop suddenly. The general rule of thumb is to have enough cash to cover your essential spending for 3 to 6 months. So if your essential bills and expenses come to £2,000 a month, you'd want between £6,000 and £12,000 set aside. Of course, bear in mind that this is just a high-level rule, and the actual amount will depend on personal circumstances, responsibilities, and liabilities. But it's still a useful rule of thumb when thinking about an emergency fund. But why is this so important? Well, it's because investments go up and down in value. So if you suddenly need cash and your investments happen to be down at that moment, you could be forced to sell at a loss. An emergency fund protects you from this. The second thing to consider is any short-term goals you have, things you want to achieve in the next 3 to 5 years or so. Things like a wedding, a house deposit, a new car, or a big holiday. For goals like these, cash savings are usually the better option. And again, this comes back to the fact that investments fluctuate. So if you need your money in 2 years and the market happens to be down when you need it, you could lose out. That's why investing really comes into its own for longer term goals, things 5 years away or more. As when you're investing for the long haul, you've got time on your side to ride out the ups and downs of the market. And this is where investing shows its true power. Yes, markets go up and down, and yes, there's always risk involved, but history shows us that over long periods, investments in shares have delivered better returns than cash sitting in a savings account. Of course, past performance doesn't guarantee future results, but the longer your time horizon, the more time your investments have to potentially grow. That said, before we get into the practical steps, there's one thing we need to talk about: risk. Here's the truth. The value of investments can go down as well as up, which means you could get back less than you put in. That's just the reality of investing, and I'm not going to sugarcoat it. But, and this is crucial, investing isn't about gambling or taking wild risks. It's about taking calculated risks. And there's a lot you can do to manage and minimize those risks, which I'll explain when we talk about choosing investments. The key thing to remember is this: with investing, you're playing the long game. You're not trying to get rich quickly, you're building wealth steadily over time, giving your money the best chance to grow for your future. Alright, so you've got your emergency fund sorted, you're comfortable with the idea of risk, and you're ready to invest. What's the first actual step? Well, first of all, you need to open an investment account. And in the UK, the account most people start with is a stocks and shares ISA. But why a stocks and shares ISA? The reason for this is simple: tax efficiency. ISA stands for Individual Savings Account, and they were introduced by the government back in the 1990s specifically to encourage people to save and invest for their futures. And here's the beautiful part: everything inside a stocks and shares ISA is entirely tax exempt. In practice, this means that there's no income tax on any dividends you receive, no capital gains tax when you sell investments that have gone up in value, and no need to declare your ISA on a self-assessment tax return. And because your gains aren't reduced by tax, you're not faced with carving out a portion of your profits later on to settle a tax bill. That means more of your returns can continue compounding, which is something that can have a surprisingly large impact over the years. Now, because of these tax advantages, there are limits to how much you can put into an ISA each year. Currently, you can invest up to £20,000 across all your ISAs in each tax year, which runs from the 6th of April to the 5th of April. That said, a stocks and shares ISA isn't your only option. If you're specifically investing for retirement, you might want to look at a self-invested personal pension, or SIP, which comes with different tax benefits that can be even more attractive for retirement savings. And if you want to know more, have a look at this video. And then there are also general investment accounts, but these don't come with the same tax breaks as ISAs, so most people only use those once they've already maxed out their £20,000 ISA allowance. Once you've decided on the type of account, your next step is choosing where to open it. In other words, choosing an investment platform or provider. This is an important decision because not all providers are created equal. So, what should you look for when choosing a platform? Well, essentially, there are three key factors to consider. The first is investment choice. Some providers offer a huge range of investments, thousands of funds, ETFs, shares, and bonds. Others are much more limited, so keep this in mind. The second is support and guidance. So, are you a complete beginner who will need help along the way, or are you more experienced and comfortable making decisions yourself? Different providers cater to different levels of experience. Moneyfarm, for example, offers a lot of support and guidance for people just getting started. The third one is fees. This is crucial because you'll typically pay a platform fee, which covers things like running your account and holding your investments securely. You'll also pay fund charges on whatever you invest in, and potentially trading costs depending on what you buy. Now, the cheapest option isn't always the best, but fees do eat into your returns over time, and even small differences in fees can add up to thousands of pounds over decades. So it's definitely worth comparing. Considering how important the platform is, you should take your time with this decision, but feel free to check the description for more information on Moneyfarm, which is definitely one of the best out there. But let's say you've opened your account. Now comes the big question: what do you actually invest in? This is where a lot of people get stuck, because suddenly you're faced with thousands of options: shares, bonds, funds, ETFs, and it can feel completely overwhelming. But here's the good news. There are really two main approaches you can take, and one of them makes this whole process much simpler. Option one is picking your own investments. If you go down this route, you'll be choosing from things like individual company shares, bonds, and funds, such as ETFs, index funds, or mutual funds. Now, there's no right or wrong answer here. It depends on your personal preference and how hands-on you want to be. But if you do choose this route, remember that different investments carry different levels of risk. Diversification is key, and a well-diversified portfolio typically includes different types of investments: shares, bonds, maybe other assets, and spreads across different countries and regions. So, don't limit yourself to the UK. The world is your oyster. Now, if all that sounds like a lot of hard work, or if you're thinking, I don't have the time or confidence to pick my own investments, then here's the second option: ready-made portfolios. These are exactly what they sound like. They're investment portfolios that come pre-built with a mix of investments, chosen and managed by professional investment managers. All you need to do is pick the portfolio that matches your goals and your comfort with risk. Some providers, like Moneyfarm, even offer a simple questionnaire that helps guide you to the right portfolio based on your circumstances. Then, once you've chosen, the investment team manages everything for you: buying, selling, and rebalancing, so you don't have to lift a finger. For most people just starting out, this is honestly the easier and more sensible route. You get professional management, proper diversification, and you don't need to become an investment expert yourself. Regardless of which one you choose, remember that the hardest part of investing isn't understanding complex financial concepts or picking the perfect investment. The hardest part is actually taking that first step and getting started. Because here's the thing: time is your biggest ally when it comes to investing. The sooner you start, the more time your money has to potentially grow. Even if you start with a small amount, that's infinitely better than waiting until you have enough money. You don't need to have all the answers, and you don't need to be an expert. You just need to begin. So, if you've been thinking about investing but haven't taken action yet, let this be your sign. Open that account and make that first investment, because your future self will thank you. And that's a wrap. I hope you found this video helpful. If you did, please subscribe to the channel for more guidance on making the most of your money. And be sure to check out the description below, where you'll find more information about Moneyfarm and how to get started with investing. And as always, see you in the next video. Bye.